Now, welcome back to part 2 of the IFRS 11 review questions. So, question 4. In question 4, we are told Blast has 30% share in a joint operation. So, you are told you don't have to think about what it is. So, it means we are using the provisions of IFRS 11 to account for its assets, liabilities, income, and expenses. That's what it means. The assets, liabilities, revenue, costs of the joint operation are apportioned on the basis of shareholding. So everything is 30%, is based on 30%. Every item, asset, liability, income, expenses, 30%. But you have to understand that joint arrangements are contractual agreements. So in another agreement, they may use different percentages for sharing the assets, liabilities, income, and expenses. So it's not the same for every arrangement. Okay, so we have the activities for 2018. The manufacturing facility cost 30 million to construct and was completed 1st December 2017 and is to be dismantled. The present value is 3 million. So here it means, assuming you've not even been told that they have paid for it, it means Blast is taking 30% of the cost of the manufacturing facility and 30% of the dismantling, the present value of the dismantling. That's what it means. During the year ended 2018, the joint operation incurred the following transactions, entered into the following transactions. Goods, cost. So this is your cost of sales, Blast 30%, revenue, Blast 30%, operating cost, Blast 30%, administrative, Blast 30%. So I'm just trying to let you see that when it comes to joint operation, it is interest in the assets and liabilities, income and expenses, and they will take their share of everything. That's what I'm trying to explain. Okay. Blast has only accounted for its share of the cost of the manufacturing facility amounting to 9 million, which means the 30% of the 30 million, Blast has already done the double entry. So it's in the books. So we are only left to recognize 30% of 3 million. 30% of 3 million. Then the revenue and costs are receivable and payable by the others. So it means they will collect the money, the revenue. The other parties to the joint arrangement will collect the monies and pay the expenses. Will collect the money and pay the expenses. Okay. Who will settle amount outstanding with Blast after each reporting date? Now, this is the requirement. Show how Blast will account for the joint operation. Show how Blast will account for joint operation. So this question just asks you for a schedule, like a schedule of the figures that will go to statement of financial position, statement of profit or loss. What figures will go? So for example, the first item, manufacturing facility, since Blast has already recognized this but has not recognized this, you are going to pass entries for the 3 million. Blast to take 30% of the 3 million, and therefore this figure of the facility will become 9,900. So this is the figure you show in the schedule, that the facility, the value of the facility is 9,900,000. The value of the facility is 9,900,000, and then you calculate depreciation on the 9,900,000. Then you will show the revenue 30%, so 3515. So let's say 1,500,000, I think, for revenue. Then the 36, then the one, this will be 300,000, and this will be 326, 600,000. So you are just showing what Blast will put in the financial statement as a joint operator. Let's see how that will look. So here you are preparing a schedule. You are preparing a schedule of the figures that Blast will recognize in the financial statement. And so for the statement of profit or loss, we are saying Blast will recognize 30% of 50 million as revenue, and therefore will debit receivables and credit um, revenue, because each share of that 50 million is 15. And so that revenue will be added to Blast's own revenue. And then the debit will be the fact that the other operator who collected the money for the receivable will give him 15 million of that revenue that was collected. The other operator collected 50 million and will give Blast share of 15 to him, so it becomes a receivable. The cost, Blast did not pay for anything. It was paid by the other operators. And so Blast will recognize 30% of the cost that has been incurred by the operation as its share of the cost, and give the corresponding payment to the one who actually paid. It's like the guy paid 36 million for the operation, the joint operation. 36 million for the joint operation. Blast share is 30%. So Blast will recognize that 30% in its profit or loss as cost of sales and credit the one to be paid. And so there will be payable to other operators. Then again, there is 1 million, 30% of that, and there is 2 million, 30% of that, all of which were paid for by the other operators. Blast did not pay. Then you have to remember that the facility is a non-current depreciable asset and must be depreciated. So that's the depreciation of the facility, the manufacturing facility. So you debit profit or loss depreciation for the year and credit accumulated depreciation or provision for depreciation. Meanwhile, remember that the 900,000 of the dismantling cost, which was debited to the facility, you debit the facility with 900,000 and you credit provisions for dismantling. So you can see that your dismantling here is 900,000 plus the unwinding of the present value to future value. Anytime there is a present value, you must unwound to future. Anytime there is a present value, you must unwound to the future. It means you took a future amount and you discounted it to the present value. You must unwound back into the future. Now, in this question, you've been given present value. In another question, you will not be given the present value. Rather, you'll be given the future value and the cost. You have to discount the future to present, and after that, unwound. So remember that. And so that's how it will look. In the statement of financial position, you are showing 9,900,000. Now, this doesn't mean you did double entry for the 9 million. It is there already, but you are showing the total value of the manufacturing facility that Blast will show in his books. It is not 9 million, it is 99 because of the dismantling cost. So you only do the double entry to bring in the 900,000, but the 9 million is already there. But in total, it is 9,900,000. I hope that is very clear. Then, of course, your accumulated depreciation, so that this becomes your carrying value of the facility at the end of the year. At the end of the year, I think 30th November 2018. Yeah. And then your receivable is coming from this receivable here of the revenue. And then your payable will be made up of this payable, this payable, this payable. So that's the total of the payable, which adds up to, let's see, 11,700. And then your provision for this monthly, of course, is the 900,000 plus the unwounding. And remember, you did a double entry here. You debit profit or loss with the unwounding finance cost, and then you credit the provision. And so these are the figures. And what this means is, in the books of Blast, let's say if Blast has an asset and the value of the asset has PPE in its financial statement, and the value of the PPE is 10,000, then now Blast will add 10,000, the operation, the figure from the operation, to its PPE already in the books. So we will have a total PPE of 19,900. This is what it means to recognize line by line. 19,900, line by line. You add receivable to your receivable balance. So if there is 10,000 receivable, it will become 10,000 plus 15,000. Payable will become 11,000 plus any payable figure in the books, adding to the line by line item in its financial statement. So is just to show the um this is to show the schedule of what is to be recognized in the books of Blast. In question 5, it is Jesse and Jesse. And here the requirement is to prepare the schedule of figures for both. Show the relevant figures that will be recognized in the statement for both. For both. So the difference between this and question 4. Question 4, you were just asked about Blast. But in question 5, the two joint um operators are Jesse and Jesse, and you are to show, so you are going to divide the figures between the two of them. So that's what you are supposed to show, and that's why I gave you a schedule, a way to deal with it. Identify the total. Always put the total down and remind yourself that Jesse will take 30%. Jesse. So if you put the item underneath, then you know that 40 goes to Jesse, 50 goes to Jesse. So that's how you, and then comment on how the figures must be reflected in the separate and consolidated financial statement. So you pay attention to that as well. So let's look at the question quickly. So again, they entered into a joint operation to purchase and sell oil pipeline. Both entities contributed equally to the purchase, and this was financed by a loan. It means they will have an asset, pipeline, PPE of 4 million, which they will share 2 million each. And then there will be a loan, because the double entry is debit the asset, credit liability. So they have a liability of 4 million, and so they will share that one to 2 million each. Then the terms of the contract. Jesse carries out all maintenance work. So Jesse will do the maintenance work. Jesse will do the maintenance work, and they will share it 60-40. So whatever Jesse pays for the maintenance work, Jesse will take 60% of it, and Jesse will take 40% of it. Both entities use the pipeline for their own operations and share any income from third parties 50-50. So when there is revenue to a third party, they will share the revenue 50-50. And the sales to third party is by Justy. So it means Justy will receive the money and will raise the invoice and receive the money, and then give a share too. So, for example, if Justy receives the money, raises an invoice, it will credit its revenue with half of it, credit Jesse with half of it, and then the total will be a debit to cash because it's receiving money. And then the full interest on the loan is initially paid by Justy. So Justy will pay for the interest, and then they will share it equally. So again, this is 50-50. Now, how much did Jesse paid for the maintenance? 240. He paid. So double entry. As far as Jesse is concerned, Jesse will take 60% of 240 and 40 to Jesse. And then income from third parties, 180, all paid to Jesse. And so Jesse received that money. 300,000 was paid for the interest by Justy. So these are the things you bear in mind, and then when you are doing the sharing, and then do it according to the headings I've provided. Let's look at how these will look in a schedule. So here we are showing the schedule. So this the headings I gave for the schedule. You identify the items. So relevant figures to be recognized in financial statement. Relevant figures to be recognized in financial statement. So this is statement of financial position, assets and liabilities. Assets and liabilities. So the pipeline being an asset, the cost was 4 million, so they share equally. They incurred liability 4 million to acquire the pipeline, and so they share that equally. Then the current account is about the receivables and the payable. The receivables and the payable. So normally the amounts will be the same. I owe you 36. You I owe you 36. So for me, it's payable. You will have receivable because you are expecting 36 from me. Okay, so there. Now the figures to the statement of profit or loss. Revenue is 50-50, so we share yeah, it's 50-50, so it's 180, we shared among them 50-50. Maintenance is 60-40, we share 60-40. Then interest is 50-50, so we share. So you must have a clarity about how much goes to each operator. Then after you've done that, we will now deal with the monies they have received from each other. So here is the deal. Revenue was by Justy. Maintenance was by Jesse. Interest was by Jesse. So here it's income. Justy received money. Maintenance was an expense, and interest cost, finance cost was also an expense. So here it is a payment, there it is a payment, here it is revenue. So this is it. So here is like we are sharing revenue, we are sharing expenses. So at the end of the day, the net expenses of Jesse will be the revenue 90, 144 expense, 156 expense. Revenue 90, 96 expense, 150 expense. So that's the net expense. It can be net revenue next time because they had a lot of revenue. So I just want you to know where the net expenses are coming from. And then these are your expenses, but you made payment of 240. So it's like you are supposed to just pay 204, but you have paid 240, and therefore the other partner, the other party owes you the difference. This is your total expense, net expense. So but then you have paid more than your net expense, which is 240, because you pay 240 for the maintenance. And so as far as Jesse is concerned, it will expect a receivable. This is its expense, this is what it paid. So that payment is 204 belongs to Jesse. That he is fine with, but the extra must be borne by Justy. Let's look at Justy. This is the total expense. This is the total net expense, 156. In addition to that, Jesse paid 300,000. So when you look at it, Jesse incurred 156 net expenses and paid 300,000. So technically, we should be refunding to Justy 300 minus 156. But we also note that Justy collected 180,000 on our behalf. 180,000 on our behalf. So when you put it all together, you will get 36,000, and then you get 36,000. So that is how come you will have a receivable of 36 and a payable of 36. All right. Go into your group, have discussion, have conversation, and then think through. Thank